Welcome to the SBH Investment Summit. I'm Carolyn Goldhaber, President of Segall, Bryant & Hamel, and with me today I have Ralph Segall and Suresh Rajagopal, the co-managers of the SBH All Cap Strategies. Good morning, Ralph and Suresh. Thanks for joining me today for the SBH Investment Summit. Ralph, in your last newsletter, you discussed how the financial markets continue to reflect the consequences of regime change. That's the name you have given to the end of the era of very low or near zero cost. But now we are in an environment of increasing rates and quantitative tightening, which has brought about a bear market in both stocks and bonds. What does this regime change mean to global economies and the market?
Thanks, Carolyn. Very glad to be here to discuss this with you. Regime change was the name that we gave to the end of the era, as you say, of declining interest rates or interest rates that were being held at zero by the central banks of the world, most notably the Fed, in order to keep economies stimulated. They could do this, they thought, because inflation simply wasn't proving to be a problem. And lo and behold, probably as a result of the pandemic, probably as a result of the supply chain disruptions, whole variety of reasons, it doesn't really matter what, the inflation genie escaped the bottle and began to create problem. And inflation is to a central banker what kryptonite is to Superman. It keeps him from doing his superhuman feats. And the central banks have been required, obliged to raise rates, to start to raise rates in order to control the inflation genie, get it back into the bottle, get it under control. If we think about it in that sense, one of the things that we think about are how this affects global economies. There are a variety of things that are going on, not the least of which are changes in population growth, particularly of the working age populations and the like. This gives us reason to think that we have to reimagine what global growth looks like going forward, because the game has changed and we're just simply not going to be able to play the way that we did.
And from a market perspective, to carry on from Ralph's commentary about the global economy, we are looking at more volatility. We're looking at pressure to earnings for companies as costs continue to rise, generally in their operational business. And so we look for, continued volatility. We look to invest in stock that'll get us through that, and we take a longer term perspective. But the markets are changing. It's not up and to the right, and we expect that to continue for some time.
All right. Well, now that the old regime is gone, what might a new growth model look like, and how are you positioning investments accordingly?
Good question. To a certain extent, what I'd like to point out is that it's not the immediate factors that are in the news every day that we're worried about. For example, we know that war in Ukraine will have problems. We know that China's response to COVID will have issues, but these aren't the things that we're thinking about in terms of the new regime. The new regime is going to be one in which growth is going to be slower, where it's going to be harder to come by because people aren't going to be able to get labor as cheaply. Companies aren't going to be able to borrow to fund or finance every project. Because interest rates have gone up and the cost of capital is rising. And because we're also, at the same time all this is going on, moving away from fossil fuel consumption into a new era of electrification. So all of these are changing the game. And our job in terms of thinking about investments in the equity markets is to be thinking about what fits, what doesn't, what worked, what won't work in the future. Suresh?
Yeah, and we, along these lines, we continue to look at our financial models. I mean, clearly in this new regime, I guess, if you want to call it that, as Ralph mentioned, just operational costs are much higher. So we're going to have to look at our DCFs or discounted cash flow models and our valuation work much closer. We spend a lot more time there. And as I mentioned before, with the increased volatility, as we make our investments, we want to be doubly sure that we're comfortable with what we're putting our capital to work at, which is clearly our clients' money. And we want to be much more diligent in the due diligence that we do for each investment that we make.
Sure. And where do you think we can find these new opportunities looking ahead?
Well, let me give you a thought on that one. One of the hallmarks of the old regime, if you will, were the high-tech companies. They really did well in an era of cheap labor, of globalization, of a spreading of communication links all over the world. That game has pretty much been penetrated right now. So do you want to still keep looking at technology? And the way we're thinking about it, one of the ways that could be attractive is to say, look, workforces are getting older. The move to automate is going to become even more intense, particularly in manufacturing processes. What kinds of companies are out there that are going to have a tailwind at their back that could benefit from that? There are going to be companies that are working on the electrification of the grid. Those are going to be the kinds of companies that we might not have looked at 5 years ago, but will come to the fore now. We'll be using the same principles. We'll be using the same approach because it works. But there'll be different names that are different sectors that are probably going to populate portfolios going forward. Any others you're thinking of, Suresh?
Yeah, typically we're not investing in the bleeding edge when it comes to advancements, and we tend to focus on companies that we think, again, that we can hold for long periods of time. And when you think about that, as Ralph mentioned, the electrification of America, essentially the infrastructure, we'd rather invest in the companies that are help building that infrastructure versus on either end of that. We also still continue to like healthcare quite a bit. As Ralph mentioned, with the aging demographic here in the U.S. as well as across the globe, the increased utilization of medical technology, candidly, is probably increasing, not decreasing. So we continue to look for companies that fit those trends of where we're not on the cutting edge, we have great management teams, good cash flow, and we can make the valuation work relative to what's out there in the macro marketplace.
Great. Well, thank you for that overview. I'm sure our clients will find that very helpful. If you have any questions of what you heard today on the equity market overview, please make sure to contact your SBH sales rep.